Once again, my name is Steven Primo. Thanks for joining us today. I am the president and founder of SpecialistTrading.com. And for those of you who aren't familiar with my site, I see a lot of people here that have attended my presentations before. But for those few of you who have not gone to my website or know exactly what Specialist Trading is, we're an educational company. And what we do is we offer courses in trading not only the Forex markets, but also the stock markets and the E-mini markets as well. Now, just to give you a little bit of background about myself, I have been trading for roughly about 35 years. I started out trading on the floor of the Pacific Stock Exchange. I was on the floor for 16 years, and 9 of those years I was a specialist for Donaldson, Lufkin, and Jenrette. I really have just about seen everything and anything in my 35 years of trading. I traded through the crash of '87, the bull markets that followed after that. I've traded the E-mini markets, Forex markets, stock markets, and so I really have picked up a lot of different information and different styles and strategies along the way, seeing what works and what doesn't work. And roughly about 1994, 1995, I left the floor to pursue my own trading to manage money. And just about 3 or 4 years ago, I really got heavily into teaching. I started mentoring a lot of students, people that wanted to learn exactly what I was doing. And I started teaching. I was the director of education for a number of websites. And then a couple of years ago, I started Specialist Trading, which basically just teaches everything that I personally use. When I'm trading the Forex markets, I'm showing you the strategies that I use. When I'm trading stocks and mini markets, I'm showing you those as well. And I have a number of techniques, once again, that I've gathered over my 35 years that I want to share with you. And I want to share with you actually one of the best techniques that I use and really incorporate in a lot of my studies and a lot of my strategies at Specialist Trading for my students. And that is what we're going to talk about today, my favorite chart pattern for trading the Forex markets. And it really works extremely well in the Forex markets because the Forex markets tend to trend so much better than stocks in the E-mini market. So this works really well. I'm going to show you how to use this chart pattern as a signpost, just to kind of validate that you are in the correct direction of whatever the currency pair is headed for that particular moment. Now, before we begin, as always, I ask that you please take a moment to view my disclaimer. I'm going to show you performance results and show you a lot of examples with this particular chart pattern. But please remember that we can in no way guarantee that any of these results will be repeated in the future. And for those of you who have attended my webinars before as well, you know we have a pretty good crowd here. I really like to take questions. I like to answer each and every one of your questions, but please wait till the end of the presentation. I know we'll still have some stragglers coming in late that will want to ask questions during the presentation, but I've noticed that it tends to really bog down the presentation, and many times if you just stick around for 2 or 3 more slides, your questions will be answered. So please write down any questions you may have. I will spend the last 15, 20 minutes answering them. If we happen to run out of time, I'll give you an email address where you can ask the question or call up and speak to us at Specialist Trading, and we can answer any questions you may have, okay? So please write down your questions and wait till the last portion of this presentation. Now, for those of you who have seen me, it's no secret. In fact, it's been well documented. I like to start out my presentations by sharing with you the really rough struggles that I had myself. I'm not one of these guys that comes up here and says, I've got it been figured out since the moment I started trading. I'm just a natural and everything works all the time. And from the first day of trading, everything worked and I have made tons of money. In fact, in the first 3 to 5 years of my trading, I struggled tremendously and I couldn't make a dime. Even though I was a specialist, I was just, basically living off my draw, and I really didn't think I was going to be a specialist for much longer because I would have probably the same experiences that many of you have. You're doing fantastically for a couple of months, and then all of a sudden, one day, you lose most of it. You just have this inconsistency in your trading. I know a lot of you come to these webinars and presentations because you're trying to get some more help because you're really struggling with your trading, and I'm here to tell you that I know exactly how you feel. I've felt the same exact way, and you wonder whether you're in the right profession or whether you're really meant out for this. But it wasn't until that a few elite traders on the floor befriended me, and they really helped me turn my way of thinking around. Not my way of trading, but my way of thinking. I know a lot of you will say, okay, I've heard this before, but really so much of trading is really your mindset and what you have been told or taught to believe what really works. And what they did is they turned my way of thinking around, and I realized that 99.9% of the things that I was taught that really works really don't work. There's a phrase that says that it's amazing how many things there are that aren't. And that's really what turned my way of thinking around. I was doing the same things that probably the majority of you in the audience today are doing. I was paying too much attention to technical indicators, a ton of technical indicators. I was paying far too much attention to news. Every bit of information or economic report that came out, I tried to decipher it to figure out if it was good or bad. Just putting too much importance on these things that my mentors taught me was really basically just noise. And so it wasn't until they really told me what the secret to really being successful in trading was, is that I started to get on this path of consistency. And that's really what it's all about. Don't let anyone tell you that they have a method or a strategy that produces hundreds and hundreds of percent every year or even every month. I mean, we have strategies that produce over 100% in less than a couple of years, but that's not what we base it off of. It's not based off of some tremendous technique that no one else has figured out. It's based off simple and basic things that you all know about. We just have put it together in a nice package and then mentor you along the way. So I don't want you to think just because we have products that as well do that, have these tremendous results. It's not about that. It's more about getting in the mindset and knowing what works. And really, success is about longevity. It's not about how much you can make. It's not about how well you're doing this particular month. It's about longevity. If you're able to trade 20, 30, 40 years down the road. As I've said many times before, I would dare to say that the majority of the traders I worked with on the floor, and some of these were tremendous traders, multimillionaires, have mostly stopped trading. Why? Because their accounts have been wiped out. So it's not that big of a deal to make that much money, because if you can't hold on to it, how good is it? What's it worth? The real secret to trading is to be able to have a consistency in your plan and to be able to generate 2 steps forward, 1 step back, so that you'll be able to be trading along the road, way down the line. Okay, so that's what we try to teach. Now, what trading should be, what was taught to me, this is what trading should really be based on. These are the 3 of the things that I want to share with you today, and we'll be looking at them in this particular chart pattern. Trading should be non-subjective, and I see that so many traders, especially beginning traders, are relying on techniques or plans or strategies or systems that are so subjective, meaning that there's no real cut and dry plan. Someone can look at that and say, oh yes, that's a buy pattern. Someone else can look at that and say, no, that's a sell pattern. You need things that are more cut and dry. We want to take the subjectivity out of it. And there's so many things, so many patterns that people rely on that are totally subjective. And that's not something that will give you the second tenet here, which is consistency. Once you have something that's non-subjective, more objectified, that is more cut and dry, I'm not going to say that works 100% of the time, because nothing does, but you get that subjectivity out of it, you'll have this consistency in it, regardless if it's a strategy or a chart pattern, which I'm going to be sharing with you today. So you need to be consistent as well. As I said, there are so many things that people are relying on, and they work great until they stop working. So we don't want to be involved in something that works great for a couple of months and then doesn't work anymore. We want this consistency. It's okay if we lose. It's okay if we go into a small, sustainable drawdown. But we just want this consistency. Everyone goes into a drawdown. All of our strategies go to drawdowns. We just don't want them to become major drawdowns. And that's where this consistency comes in. So 2 steps forward, 1 step back. And then lastly, it must be as simple as possible. Whether you're looking at a chart pattern, whether you're looking at a strategy, anything, you have to keep it simple. There are no traders I know of today that have been trading as long as I have. Some have been trading close to 40, 50 years. And anytime I get together with them, some live in Europe, some live in the United States, their plans are extremely, extremely simple. In fact, most people would laugh, saying, this is what sustained you all these years? I mean, most of them have 2, 3, 4 rules at top. It's only the beginning traders, the ones that want to make millions of dollars, that have all these phantasmic plans, where you have 20, 30, 40 rules, different indicators, tons of news, that you rely on. It's too complicated. So look at the traders that have been around for ages. Their plans are extremely simple. They're not relying on all this noise. And look at the ones that have just been around or just started, that were trying to sell you their fantastic strategy. Most of them have only been around for 2 to 5 years, and their plans are extremely complicated. So the truth is in the tape. You can see that the ones that have been around for a long time keep things as simple as possible. Just remember the same thing that was taught to me. It's the easiest thing in the world. The easiest thing in the world to complicate your trading. Anyone can do that. You can buy 20 systems. You can have 20 chart monitors in front of you. You can have 3 TVs on, 5 phones in front of you. It doesn't take anyone advanced to do that. But it's extremely difficult to simplify your trading. It's extremely difficult to rely on those things, to not care about news, to not care about being in 20 different chat rooms or trading rooms, just to rely on the chart you're looking at, the one market you're trading. That's where the real challenge comes in. Once you get to that point, you'll see that your trading turns around. All right. So we want non-subjectivity. We want to be consistent, and we want to keep things as simple as possible. This is what trading should be. All right. Next time you read a book or read something in a magazine or go to another presentation, just see if it follows along these 3 guidelines. Okay. All right. So that was the goal that was taught to me. That was the edge that turned my trading around, and that's my goal at Specialist Trading. All of my students and people that I'm mentoring, my goal is to teach you how to trade with this edge, which is really rooted in simplicity. So as you're going to be seeing later on today, you're going to see how simple it is, but they really have this nice consistency to your trading, all of these different techniques and methods, which I share with you in my presentation. All right, now before we begin, I just want to remind you that you can get a lot of more information about Specialist Trading and about the courses with the microsite that FX Street has put together for us. Now, this is the link. I realize it's a little bit difficult to copy right here, so we shortened it for you. If you want to go to the link, you can go to the shortened version, and it'll take you exactly to the same microsite for Specialist Trading that FX Street has so graciously put together for us. So that way you can get more information, anything about our website, anything about me, anything about our strategies, you can go there, and it'll actually take you to this microsite right here. And as I said, you can find out about our different course descriptions, and you'll find out a little bit more about myself, and you can also purchase courses there as well. So it's a great microsite. I invite you to please take a look at it. And once again, FX Street put that together for us. All right, here's what you're going to learn today. Let's start off. We're going to talk about, first of all, things that I know a lot of you rely on, and that are basically pretty fair edges, but how we use them incorrectly. And those are formation patterns. Now, these are patterns where you use a lot of data that come up with some type of formation, and in that charting formation, you'll see a pattern that we rely on, either to go long or to go short, or to give you some type of a clue as to whether to go long or short. Then we'll look at probably the most common way of viewing a chart for the Forex markets, candlestick charts. And we're going to look at some patterns with candlesticks. We're going to show you how actually they can be used tremendously incorrectly. And I'm going to show you that as well. And then I'm going to share with you my favorite chart pattern. All right, this is probably something that's incorporated in about 3/4 of the strategies we teach and share with you at Specialist Trading as a member. And I'm going to share with you the actual chart pattern that is incorporated in a lot of our strategies. So this is what we're going to focus on today, all right? Once again, before we begin, if you have a question, please just wait till the end. I'll have plenty of time, I promise you, to answer each and every question. And then if you have a question that you happen to come up with once we've concluded, I'll still give you an email address as well as a phone number where you can contact us. All right, so let's begin. Let's first talk about formation patterns. Once again, these are chart patterns, but we use a lot of data, a lot of different, if we're looking at daily bars or weekly bars or tick bars, we're using a lot of these to come up with some type of formation, which gives us a larger pattern, which gives us a clue as to which direction the market may be headed. And these are some of the basic ones. I'm sure a lot of you have used them, and they're actually fairly good. But the basic ones are an ascending triangle. All right, this is a pattern here where we're looking for is some type of upward move, a downward move to the downside, then another upward move, and then a lower move, which is not as low. So we form this kind of triangle. And on the third time, the common wisdom is that once we break out the third time, we will go up much higher. So this is a bullish type of pattern, charting pattern. Now, in reverse, we have the descending triangle, which is the exact same thing. You just turn it upside down. We go down. We have a nice bounce. We make sort of a double bottom again, have another bounce. And on the third time, this is where you have this descending triangle where we should, conventional wisdom says we should break down on the third time. And this is telling you, it's giving you a clue that this particular pattern says now you have some type of downward bias. All right, so those are very common. Another common one is an ascending wedge. All right, now this is the type of thing, as you can see here, if you put some lines to this, we have a nice wedge. We've been going upwards, which appears to be a nice sustained upward move. But once we break that, this is a real strong sign that the move to the upside is over, and we're probably going to have a very sharp move to the downside. And once again, with all of these patterns, you can reverse the concept just as easily. You have a descending wedge here, and then once the conventional wisdom says once we break up above this line, well, we can have a nice move to the upside, and you'll really stop the downtrend, and things should be going very strongly to the upside. You have a nice upward bias. Another, probably most common of all the patterns, is a head and shoulders pattern. Once again, we have the left shoulder, the head, the right shoulder, and here's the neckline, all right, the support, all right. Well, the way the pattern works is once we break down, you have a strong bias to the downside, all right, and just reverse it for an inverted head and shoulders. Now, all of these are extremely common. Once again, I was using these 30 years ago when I was first starting to trade on the floor. Here's the trouble with all of these. All right. Remember we talked about the first category of things being non-subjective. All of these patterns are subjective, or they have a tinge of subjectivity in them. You know, where exactly do you draw the line? Someone sees a left shoulder, which someone else would see as a double top or a double bottom. See, there's too much subjectivity. We want things cut and dry. When you want to be trading, you want to know that this is a clear-cut signal that we're going up and a clear-cut signal that we're going down. You don't want this air of subjectivity where someone could look at the same chart and see the exact opposite of it. That's where you're going to get that inconsistency, and that's probably what's leading a lot of traders in today's presentation to having rough months because they're using this and relying on things that it's just not cut and dry. Let me give you an example here. This is the dollar yen in a 4-hour chart. All right, just this last month, starting in the first week of March. All right, now we have a nice uptrend here, and someone looking at this chart could say, okay, well, I really don't know what we're looking for, but someone who has studied the particular chart pattern would say, well, wait a minute, we have a clear-cut head and shoulders here. We have the shoulder, the head, double top, and then another small right shoulder. So what this would mean is that on this 4-hour chart, we have a nice sell signal here. We've broken the neckline or the support. This is where you'd sell. So you just jump in and sell there, and then look what happens. So you hold on for a couple of days, and by that time, you don't want to take the loss, so you stop yourself out. You get out with a loss, okay? And as the chart progresses, we see here now that it started to go back down in our direction that we originally wanted to go. But we just couldn't wait that long. We didn't want to have that much of risk. But now, guess what? We have another head and shoulder. So once again, the subjectivity comes in, and we have another head and shoulder. So, you know, why not jump in once again? We have a shoulder, a head, and a shoulder, and there's the nice neckline. So this, obviously, is the correct pattern. So this is where we should be selling once we break below there, and look what happens. It goes right back up. So see, it's too subjective. There's not enough cut and dryness in these patterns. Now, another thing here is probably support and resistance. I don't personally use any of these chart patterns, nor do I use support and resistance. Why? I know a lot of traders do, but why? Because they're too subjective. One man's ceiling is another man's floor, or one trader's ceiling is another man's trader's floor. It's just not cut and dry. Now let me show you an example once again. Here's the British pound, okay? This was going back last year. Now we have a nice uptrend in place. We have a nice stair step where we go up. We have a pullback. We go up again, and according to support and resistance, we should have another pullback within this uptrend, and we should be purchasing the British pound roughly around support, which would be roughly down here. So anywhere around the support level, you want to be a buyer because let's say your strategy or the news, you're following the British pound, you think it's going higher. So we get down to that level, and it really doesn't hold very well. So you say, well, I'm willing to hold on, though. I still feel strongly about the British pound. And guess what? There's even a better support level right here. So let's hold on to it, and let's buy more down at the second support. And guess what happens? So you see, we want something that's more cut and dry. I'm not going to tell you that everything I look at and everything I trade works 100% of the time. I'm not, but I want something that gives me a little higher odds for success. And through my 35 years, I have not seen enough consistency in using the chart patterns, which I just showed you, as well as support and resistance. I know a lot of traders make tremendous amounts of money and are very successful using these things, but they have this inner kind of wisdom where they can see when something is a valid support and when something isn't, or when something is a valid chart pattern and when something isn't. And that's great for them, but in order to teach that, you have to be able to show what you're seeing, and they can't teach that. They can only tell what they see. So this is something that's too subjective. Once again, I know of a lot of traders that are tremendously successful using support and resistance levels as well as these chart patterns. But in terms of wanting to teach people the way I was taught, you can't teach it because what they're seeing is something that they see, that only they see. All right? And just ask yourself, but if you've used these things, these patterns or support and resistance, how well have they worked for you? Do they work great sometimes until they stop working? That's the sign that it's too subjective, and we want more consistency in something that we're following. All right, so let's move on now to the second type of chart patterns. These are individual candlestick patterns. Everyone I know that trades the Forex loves to look at candlestick patterns. Okay, that's the main pattern you're looking at, candlesticks, and more than stocks, more than the E-mini. And so everyone loves candlestick patterns. The only thing is they're faulty. There's one certain characteristic with candlestick patterns that are faulty. Now, I will tell you that many of our strategies we have for Forex rely on candlestick patterns. So I'm not going to tell you that I don't use them personally. In fact, probably our best strategy, which I'm going to be talking about later on, is based off of candlesticks. But there is a fault with the way most people use these particular patterns. Now here's just a sample of most of these patterns, anything from a doji to an engulfing pattern to a piercing line to a shooting star, and they're all fine patterns. As I said, I incorporate these in a number of our strategies for trading the Forex markets. But the trouble is that they don't have a high level of consistency unless you are trading with the trend. Okay? So in order to use these, you must be in sync with the trend. Now that sounds simple enough, but here's the problem. Everyone has a different idea of what the trend is. All right? Someone can say, well, the trend is always formulated by looking at the higher time frame, looking at the daily bar, and then going down to an hourly chart, or looking at a weekly and going down to a daily. Or someone would say, no, the trend is used is by some indicators that I follow. Or where the trend is based off of patterns, higher highs, lower lows. So everyone has a different idea of what the trend is. So once again, our second category, there's no consistency. We need to have a basic plan of attack that calculates the trend, that has a very nice consistency to it, that isn't 100% successful, because once again, nothing is, but has a high level of consistency, and then we can incorporate these candlestick patterns. And here's a perfect example. This is the Australian dollar at the beginning of the month. Now we have a upward moving slope here in the Australian dollar. Not a lot, but we have an upward moving, and then guess what? We have a very nice bullish engulfing pattern. Okay, now this is very bullish according to these candlestick patterns. This is the type of pattern you're looking for to go long. So most traders would see this and go, boy, this is what I'm looking for. This is what I studied, or I went to that webinar and this guy talked about candlesticks. This is one of the best patterns. So you go in and buy, and look what happens. Okay, and that's because just using these patterns alone is not enough. You have to have other pieces of the puzzle, such as trend and just a lot of other things that we teach at Specialist Trading, so that everything fits in nicely. Okay, it's very simple, but you just got to make sure that everything's in sync. So this is what you really need, and that's why candlestick trading is faulty. That's why most traders who use them are using them incorrectly, because they're out of sync with the overall trend. Someone can say, well, I'm in sync with the short-term trend, but maybe you need a longer-term trend. So there's a lot of things that come into play. You just cannot rely on the candlestick pattern. Even though, as I said, I use them personally, and a number of our strategies are based off of them, we just don't rely on the pattern itself. There are other things that come into play. All right. So now let's get down to what this presentation is about, my favorite pattern. All right. Now this really is not a pattern that's a strategy. The first thing I want to say right off the bat is it's not a strategy. You can incorporate it, and I hope that you do implement it within a strategy. And I really don't care whatever that strategy is based on, that's fine. All right. It can be strategy that's based off of the full moon. It can be a strategy that's based off of news or different reports that come out, or it can be a strategy that's based off of indicators. I don't care. But the thing I'm trying to show you today and share with you today is once you see this pattern, it's like giving you the green light to jump on board. All right? Now, this is what the pattern is. It's our last category. Remember we talked about simplicity? We've also already talked about things that are that are too subjective. We've already talked about things that aren't consistent. Now let's talk about simplicity. This is it. This is my favorite pattern, okay? What you want to do is you want to look for bars like this. You want to look for a bar that closes either at its very high or in the top 25% of its range, okay? If you see a bar like that, then you should strongly be looking to buy. That's it. I told you you have to keep things as simple as possible, but this is probably the greatest clue the market can give you, seeing a bar like this. All right? Now, conversely, a bar like this. What you're looking for is a bar that either closes at the very bottom of its range or in the bottom 25%. If you find a bar like that and you have a signal to go short, then you should really jump on in. Or if you're already in a trade, it's giving you confirmation that you're in the right direction. See, what this is the market loves to give you clues. You know, people love to look outside of the market for clues. They love to look for news. They love to join all these chat rooms or trading rooms. That way they'll get a clue about what's going to happen. That way maybe someone else knows what they should do. And so they're looking for outside information, outside sources to tell them what to do and how to trade. When in actuality, all you have to do is look at the chart. The chart is telling you everything. And right here, this is probably one of the nicest signs you'll ever see, either confirming or telling you as to what the market wants to do, regardless of the time frame, regardless of, we're going up or down, does not matter. If this is a weekly bar or a tick bar, does not matter at all. All right, so how do we implement this particular chart pattern, my favorite chart pattern? Here's the rule here. If your strategy, once again, we don't care what your strategy is based off of, but if it gives you a buy signal, use this chart pattern. That's the first chart pattern we showed you where you close either at the top or at least the top 25%. Use it either as an entry, a directional tool, or at the very least a signpost that the market has an upward bias. Okay? That's all you need to know. Now, what if you're going short? Well, if your strategy gives you a sell signal, use this chart pattern, which is just basically one bar that either closes at the low or in the bottom 25%. Use it either as an entry, a directional tool, or at the very least a signpost that the market is giving you a clue as to the direction it wants to go. That is the most simplest and easiest pattern I can share with you. As I said, we incorporate this in a number of our strategies. This is how important this particular pattern is. This is not just something I'm giving you a free presentation today. This is something we use on a daily basis. All right, so let's look and see how this is incorporated within daily bars. Now, just to give you a little insight, I would say the best way to use this if you're looking at daily bars is to look for some type of pullback strategy. All right, so once you have a nice upward move, look for either a sideways or a downward pullback, and then look for this bar. All right, this bar that closes in the top 25%. If you have a downward move, then look for some type of sideways consolidation or upward bounce, and then look for this bar that closes in the bottom 25%. Here's an example with the euro dollar from February to March of the past few months, and we see we have a nice sustained uptrend here, looking back in hindsight, but how could we have taken advantage of it? Well, we had a consolidation at this point, and looking at all these bars, we see here that we closed a very nice upward range here, but then we went into consolidation, and it wasn't until we got here that we closed in the top 25%. We had a nice 150 pip move to the upside. And then once we started to sell off, we see that we started to pull back, and then we closed upwards again, and then we had another move to the upside. Okay? And remember, this is just a piece of the puzzle. There's a lot of other things that go in with this. This is just a clue that the market gives you in a chart pattern telling you its bias. Here's another chart here, the Canadian dollar going back the last few months. Okay? We have kind of sideways action, and then we kind of develop this range here. But as we see, once we got these clues from the market, the bottom 25%, and this one closed near its low, how the market told you it was, at least for a short time, going in that direction. See, we're not concerned with bars that close somewhere in this mid-range. We're more concerned with bars that close either in the top or bottom of their range. The closer to the bottom, the better if we're going short. The closer to the top, the better if we're going long. How about weekly bars? Now, the way to use this, my suggestion in weekly bars is to use it as a directional tool rather than some type of entry tool. Use it as a directional tool that is confirming that you're in sync with the trend, especially if we're looking at these longer term trends in the Forex market. All right, now here's the weekly chart of the dollar yen. We had this really nice run up to the upside. And coming into this, we see we closed at the very low here and here, telling us that there was still some negative bias. But then on this bar, we had a series of bars that closed right near their highs, 4 bars in a row roughly. And the entire time, look what happened. So basically, the market was giving you confirmation and telling you that we're going higher, most likely. And you can incorporate any strategy you want. If you want to go down to a smaller time frame, that's fine. But on the weekly time frame, it was because it closed at this upper range, it was telling you we're probably going higher. Don't try to pick a top. Just go in sync with the market. See, the market was giving you a clue that it's going higher. That's all you need to listen to. Don't need to listen to these gurus on TV or waste your money with different chat rooms or reports. Just listen to the market. It's a lot cheaper and it's a lot easier. Here's a weekly chart of the dollar Swiss franc, and this was going back last year. We had a really nice sustained downward move here. Now, a lot of people were really caught off guard with that, but if we look, we see that there were so many bars that closed either at or near their low, where the market was just totally giving you clues that we're going lower. It wasn't until this point, right down here in August, that guess what? We closed at the very high. So that was a clue, once again, that the market was telling you that it most likely is now going to shift bias to the upside. And then we got another confirmation right here where we closed just a few pips below the high on a weekly chart. And monthly bars. Once again, if we're going to be looking at monthly bars, I would suggest the same thing. Look for bars that close towards the high or low and as close to the top or as close to the bottom as possible as a directional tool. Here's a monthly bar of the British pound, a monthly chart, I should say. Okay. Now, if we look, we see here that we closed at the tops on 3 successive months here, and we had some nice moves. It doesn't look like it, but you roughly had about 1,000 pips upward until this move to the downside here. It closed nearly towards the low, but then it was followed by more bars closing towards the low, and once again, all giving you signals. Now, I know it's tough to understand because a lot of people will say, well, yeah, but I see other bars that are closing the opposite direction. But once you incorporate other tools and techniques which we teach you, you can see which side you should be on, and then you look for those bars that will give you confirmation. So there are other simple things as well that we teach, and they're very simple, that I've also given away in free webinars with FXB, which I show you on how to be in sync with the trend and how to look for this. And for those people who like to trade intraday, the same technique transfers over into those markets as well. Here's a 60-minute or hourly chart of the dollar Swiss franc going back to just, I believe, a couple of days ago, the 28th and the 29th of March. And as we see here, we had a bar close at its very high, followed by a quick 40-pip gain. All these other bars were basically closing somewhere mid-range until we had another bar right here, close at the very high. And once again, you had another 50-pip, really quick gain. I would use this when you're going down to smaller time frames for actual entries. If you have a strategy that is giving you a signal, use it for an entry confirmation, and then just jump on in. Okay? Here's a 1,000-tick bar chart of the euro-yen, going back once again to just a few days ago on the 30th of March. Okay? We have 3 bars here that close at their very low. And each time, the market went lower. It wasn't until this bar right here that we closed at the very high, and guess what? The trend changed. So when you're using these for monthly charts, use them as directional tools. When you're using them down for intraday, I would use them for entry tools. But remember, you have to have a strategy and all the pieces of the puzzle in place. It's not just enough to rely on this one pattern. So please remember, in conclusion, this is not a strategy, all right? This is just a piece of the puzzle that you can add to any strategy. Once again, let's say you get a buy signal, depending on whatever your strategy is. I would wait till you see one of these bars confirming the direction in which your signal is given. So if you get a buy signal, you want to wait for a bar that closes in the top 25%. If it closes at the very top, that's even better. And that's your clue to get in, okay? And vice versa if you're going short. Now, this is best used as a directional tool. So if you're going for different time frames, It's just a confirmation that you're in sync. So if you're long and then you see a bar that closes at the very low and then some bars start to follow it, the market was giving you a clue that you're not in sync and your strategy is probably going to have a losing trade. So use it as a guidepost, some type of clue telling you that either you are in sync with the market or are not in sync. All right? See how we try to keep things as cut and dry as possible? There's no subjectivity. You know, it's not like, well, there's a 50-50 chance it may be. No, we're telling you that that's your clue. The market is telling you we're most likely either going higher or lower. Okay? And there is a consistency, as you just saw. We just showed you daily, weekly, monthly, and intraday charts, where this transfers over into each and every time frame. Now, lastly, the higher or lower the close, the better the pattern. So even though closing in the bottom or top 25% is good, if it closes at the very high or the very low, it's going to be a much more valid pattern. Okay? Not guaranteed. Once again, nothing is guaranteed, but it's just more valid pattern to look at. Now, let's recap. We talked about the three things that really were taught to me that I try to pass on to you, and that's about subjectivity, consistency, and keeping things as simple as possible. And we saw that when you use formation patterns, such as ascending triangles and head and shoulders, and especially support and resistance, there's just too much subjectivity involved. Okay? There are a lot of traders that do very well off this, but it's too subjective. They're seeing something that the rest of us don't see. And that's not a valid strategy, in my opinion. It's got to be something that all of us see. So I stay away from formation patterns because there's too much subjectivity. Now, candlestick patterns are great patterns. We incorporate them. I'm going to talk to you in a few minutes about a great strategy that uses candlesticks. But they have to be used properly. And I would venture to say that the majority of all traders use them incorrectly. You must be in sync with the trend. All right? Sounds easy enough, but everyone has a different idea of how to find a trend. One man's uptrend can be another man's downtrend. So you have to be able to find a really nice way in which to incorporate trend in order for them to work properly. So you just cannot use the candlesticks just the way they are. So lastly, I share with you my favorite chart pattern, which is based in the last category, simplicity. You can just see how simple it is. It's just one bar. We either close at the top or the bottom to have the most valid clue there is. Remember, this chart pattern, once again, is not a strategy. It's just a way of learning how to listen to the market, give you that clue. You know, as I always state, keep things as simple as possible, either in your trading or in your trading plan. You know, don't rely so much on what was taught to me as being noise, by joining all of these groups and listening to TV too much and trying to discern news. It really comes down to noise. Keep things simple. The only thing you really need to learn about and what you should be focusing on is the chart in front of you. All the answers are right there, okay, as you saw in these last examples. It's a lot easier and it's less expensive. Now, I want to invite each and every one of you, in closing here, just to become a member of my website. As you see, this is specialisttrading.com, the homepage. I offer courses in stock trading, e-mini trading, and in forex trading, as you just saw. Now, each course comes with upwards of 10 different strategies for each and every different category. All right, now we talked about forex today, and one of the best courses we have is our strategy number 5, okay, which incorporates everything I talked about today. Everything I talked about is my favorite chart pattern. Now, just really quickly, we've generated gains of over 115% roughly in less than 2 years. Now, I'm not going to guarantee that that will continue, but it's more about the consistency that we're more concerned with. All right. Now, should you decide to become a member and purchase strategy number 5, I give you detailed instructions. This comes with 10 online videos. We talk about the entries, the exits, and the stops. This also comes with 1-year trade signal alerts. Now, that 115% was all generated by the trade signals that we give to our members on a nightly basis when these signals appear. So you're going to, once you purchase this course, you'll get 1-year free trade signal alerts. You also get 1-year weekly trading lessons. This is where I give a weekly webinar, such as I did today, giving you different techniques and methods on how to improve your trading. We provide you with a PDF of these rules and personal email access with myself. So if you have any questions, you can email me, and I'll answer your question as soon as possible. Now, this trading course usually just runs, this individual course, $595. We're dropping it roughly about 40% down to $340, I should say, for FX Street attendees only. All right, so this is for a limited time. This is a great deal. This is probably our most successful strategy to date, strategy number 5. Okay, we provide you with all of this information. And once again, the best way to learn about our courses and more information about specialist trading is to go to the microsite which FX Street provided for us. Here is the common link, but here is the shortened link that we gave to you. You might want to copy that down. And this is where you go to the microsite. If you have any questions about price or all the different strategies or mentoring things we add and have it, or you can go to that and you'll bring you up to this page right here. Gives you course descriptions and a lot more information. All right, we have about 10 or 15 minutes left for questions. Once again, visit my site, specialisttrading.com, or if you're interested in purchasing strategy number 5 for the discounted price of 40% off, you can go to protraderstrategies.com, or once again, if you have any questions after this presentation, you can contact our VP of Global Sales, James, at jamesp@specialisttrading.com, or give us a call at 310-295-1626. Okay, Philip has a question. Can trading these bars, excuse me, my favorite pattern, be dangerous if we attempt to use them when price is in a tight consolidation? Yes, it can be, but once again, I'm going to say what I said before. These, my favorite chart pattern, these bars I just talked about, are not a strategy. So in other words, I don't want anyone to go away today thinking that, well, I'll just trade these bars, the way Philip kind of alluded to here in the beginning of the sentence, that can trading these bars. There are other pieces of the puzzle that must come into play, such as money management, such as entry techniques, such as stop placement, exits. These are all things we teach, but once again, if you have a strategy that you feel confident with, just add this onto it. So let's say you get into a rangy market, but your strategy gives you a buy signal. Well, many times you're going to get whipsawed because you're in this range here, but the market is giving you a clue that it's breaking out of that range by showing you one of these bars. So I would wait for that as an entry signal or as a confirmation before jumping in. So many times this will keep you out of trouble by simply waiting to see one of these bars before you just jump in. Okay? Many times while you're in a rangy type of pattern, you won't see these bars. Now, we teach you ways how to keep out of these rangy markets or these drawdowns within these particular markets. So this is all within the class as well in our mentoring. 16-Minute Man is saying, are deep retraces in a trend better places to buy and sell than, say, a single candle retracement? Or are results similar for both? That's a good question. I don't have any results per se. I haven't quantified that, going over all the different markets and different time frames. But I would say, you know, once again, it all relies on different pieces of the puzzle. We've all seen that we see these real deep retracements, and we think, boy, I'm going to get a great price. And so you jump in, just as I showed you in that British pound example that was using support and resistance, and it just keeps going lower and lower. So there are a lot of things you need to stress with money management, and I think the most important tool we have is our buy-sell line, and that's where we really keep you out of trouble and show you how to be in sync with the trend. And that's probably our most important technique at Specialist Trading, and I've given probably 10 presentations at FX Street talking about that. Maybe my next presentation I'll go into it, but that's a great tool that you should incorporate with using these bars. That will help you. That probably will save you a lot of sleepless nights by using this simple tool, the buy-sell line. Okay? I think that's the best way I can answer your question. I know that that's what keeps us out of trouble. Many times we'll get a real deep retracement, but price is below the buy-sell line, so we're not going to go into the trade. And it saves us a lot of heartache because then it turns into a big loser like that British pound trade. Or other times we'll get a deep retracement, but it's above the buy-sell line, so this indicator is telling us that it's okay to buy, and it turns out to be a good trade. So these are other techniques and tips that we have for our members, and I've shared with you for free many times in these presentations. Any more questions? Once again, if you have any questions and the presentation is concluded, you can call us up directly at 310-295-1626. Or you can email our VP of Global Sales, James, at jamesp@specialisttrading.com. Now, remember, going into closing here, I know there's someone, I believe, after me, but going into closing, the three things, regardless if you want to use my favorite chart pattern or not, this is incorporated in a lot of our strategies, but I know for some people it just may not be their cup of tea. That's all right. I totally understand. The main thing I want to impress upon you today is those three those three categories that we stressed about, go back and look at your trading. And if you're having trouble with it, if you're not successful or you just can't seem to go forward the way I did for a number of years, it's most likely that you're relying on things that are too subjective. It's most likely that you're relying on things that are not consistent. They work until they don't work, and then they don't work anymore for a long time. Or it's that you're complicating your trading far too much. So just go back, whether you want to use this charting pattern or not, just try and keep your trading extremely simple. Don't rely on subjective things, where someone can see something and you don't see it. You don't understand why you're not seeing that. It's because it's subjective. That's why certain subject strategies work well for others and don't work well for the majority of people, because they're seeing something that the rest of us can't, and you can't teach that. It's just a feeling they have. And there's a lot of great traders that trade just off that feel, but they can't teach it. And my goal is to teach you how to trade with this edge. So in order to teach it, it's got to be more objective. It's got to be something that's cut and dry, such as this pattern, and that you know right off the bat that you have a bias either to the upside or a bias to the downside. Okay? That will give you the consistency, and once again, if it's simple, you'll have even greater chances for success, in my opinion. Okay? Now, if there are no more questions, this brings us to the conclusion of this particular presentation. Once again, I invite you to visit my site, specialisttrading.com, or go to protraderstrategies.com. That's our sister site where we actually sell our individual strategies. You can get more information, or you can actually go to that microsite that Epic Street put together for us. Remember, any questions, call us up directly at 310-295-1626, or contact our VP of Global Sales, James, at jamesp@specialisttrading.com. Thank you so much for attending. We shall see you right back here next month. Bye-bye.